Now joined by a Fed district president. We're with the president of Kansas City Federal Reserve Bank, Thomas Hoenig. Thank you so much for taking the time to join us.
Glad to join.
So just hearing from Scott Landman in Washington, D.C. there about the historic nature of these revelations, do you think it'll change the way the Fed operates in any way?
Well, I don't know the answer to that, of course, but I do think that when you're in the middle of a financial crisis that is global and you're the world's reserve currency, you often find yourself needing to make loans to various financial institutions that operate in this country. I think the real issue, however, that I hope comes out of this is my issue, which is that the institutions worldwide, but certainly in the United States, are too big to fail. And therefore you find yourself in these financial crises, find yourself needing to make loans of substantial amounts to keep the rest of the economy melting down. And unfortunately, one of the consequences of this crisis and some of the activities that they were engaged in was the fact that we had then 10% unemployment. So the real issue is too big to fail.
I know you've spoken a great deal about that issue, and you touched on unemployment there, so let me pick up on that.
Sure.
Non-farm payrolls are out today. March unemployment rate unexpectedly declined to, what, 8.8%? I'm guessing you're pretty encouraged by today's report.
I was pleased with today's report. It shows a continuation of the improving economy in the United States that will, I think, not only be good for the United States, but for the world. And so this is what I had anticipated, and I'm very pleased that it's continuing along an improving trend.
But no change in average hourly earnings, so wages are not rising. Something to be concerned about?
Well, I think that the fact that the employment numbers are improving, I think there's a good possibility over time that wages will start to improve as well. I think there has been some improvement in wages over the last several months, and that should continue as the economy itself continues to improve. And one data point is not what you draw your conclusions from, it's the trend, and I see a positive trend.
And when you speak about that trend, it seems that one thing we've been seeing fairly consistently, I don't know, maybe you'll disagree, the participation rate, it's that too unchanged. 45.5% of those unemployed have been unemployed for 6 months or longer.
Correct.
So that's a pretty worrying trend, isn't it, long-term unemployment?
No, it's not a worrying trend other than it is a disappointment. But the fact that you're in an improving economy, it's disappointing. You do not want to see anyone out of jobs. I mean, that's the tragedy of the crisis. So you don't want to see that. You want to see it continuing to improve, and that's what we're seeing. Now, if you try to accelerate it too quickly, and this is one of my issues, with very low interest rates, you create the conditions that lead to imbalances, and I think longer term can lead to inflationary problems. And the consequence of that, as in the last time, is higher unemployment. So we want to be very careful how we balance our policies going forward to make sure that this is a sustainable recovery, that people that are employed stay employed, and that people are added systematically to the employment roles with confidence. And that's what we need to look forward to.
But if wages are not rising, is it possible that inflation will seriously spike?
One month data on wages is not going to tell you the story. I think as this continues to improve and the cost of living itself continues to rise, then you need to see, and I think you will see, improving wages as well. I hope so. That has to be the goal.
Realistically, is there a possibility then that the Fed might stop short at their next meeting at the end of April, shorten their bond buying program either by duration or amount?
Well, I don't have the slightest idea. My view is that QE2 was unnecessary because we have lots of liquidity into the marketplace now. We have interest rates at zero in the policy rate, and that will have momentum. There is a lot of, even with all the discussions around at the federal level in the United States continuing, that still is in place. So there's continued momentum for the economy to improve, and that's what we need to be aware of. And my concern wasn't putting QE2, and my concern would be if there was any further easing into a recovery, is that you do accelerate, not just, hopefully you think you're going to accelerate employment, but you accelerate imbalances that then cost you dearly later, and that's what you need to be aware of.
So after June, what should happen to the federal funds rate and the balance sheet?
I have no idea. We'll see what happens, because what you do is you withdraw it. There's a lot out there. The markets are really quite capable of judging, anticipating. My own view has been that the federal funds rate should come up modestly. Credits and markets don't work well when it's at zero, so you need to begin to move it. Now, my goal is to watch the market, watch the real economy, most of all, and move your rate back in a careful way towards 1%, then to pause, see how the economy is working, and then to move it very gradually, carefully, and then to move it. Now, gradually may mean a 25, may mean a 50, but to move it towards that 1%, and then to take a pause, look, see how it is, and then move it back towards a number that is consistent with the growth rate at that point, but off of zero.
How concerned are you about inflation?
Well, I'm not concerned in the sense that it's can't be dealt with. I am concerned that the monetary policy that we now have in place is highly stimulative. If it remains in place, then I am concerned that the inflationary impulses will gain momentum. You'll see it in asset values, as we already are seeing it.
Are you more worried about asset bubbles than
I'm worried about both because part of this crisis was the result of an asset bubble. So yeah, you take that very seriously. But it's not just asset values. If you leave this in place, this very accommodative monetary policy, then you do bring inflationary impulses to the market as well. And both those will be harmful to the long-run stability and the long-run growth of the U.S. economy, and I suspect the world economy as well.
So how soon should they move up to 1%? I mean, is this something that needs to be done in the next few months?
Well, I would like to see it done, first of all, be very careful how the economy is going, but I said some time ago publicly that sometime in the fall would be, late summer, fall would be appropriate as we watch these numbers, these employment numbers, and what else comes out. And I think those are the sorts of things that we need to think about at least, and then be prepared to act on if the market and if the real economy continues to show strength. And that way we will have an improving economy and hopefully begin to take and adjust for the inflationary and asset value impulses that otherwise would be in the economy.
And Tom, very briefly, with energy prices rising, gasoline, petrol, food prices, is that likely to change consumer behavior, spending behavior in a way that would mean inflation wouldn't be so much of a threat or something to worry about?
Well, since inflation is ultimately a monetary phenomenon, that will drive the inflation. Now, people certainly, as they see these prices come, are going to adjust their consumption habits to minimize the impact of them. So there may be that effect, but fundamentally, inflation wins out when you allow policy to be too accommodative too long. And that's a risk we ought to avoid.
You've spoken a great deal about banks that are too big to fail.
Correct.
Are there any problems? Can you be specific about any banks that are still too big to fail in the US?
Well, any bank in the top 4 or 5 are clearly too big to fail. There's an effort going on right now among the regulatory institutions to identify systemically important financial institutions. That almost by definition is a group of banks that will be thought of as too big to fail. And the issues around that are that they have an advantage over other banks. Their cost of capital is lower. Their ability from the market's point of view to take on more risk increases because everyone knows they're going to get their money back no matter what they do. And this causes very bad behavior. The incentives are wrong.
So legislation isn't going to work?
Well, the legislation hasn't been, needs to be thought about in terms of the next round, in my opinion, to deal with that. Because right now, the legislation has enhanced supervision, which won't by itself work. Does have some resolution conditions, but they involve making judgments over a weekend rather than clear rules-based. And therefore, they will, when you go into the crisis, you cannot make those kinds of decisions. There is too much at risk, as we learn over and over again. So they have to be broken up before that is allowed to happen, as was done after the Great Depression, when we in the United States introduced what was called Glass-Steagall, took the high-risk activities that didn't get public protection and moved them into other institutions, and then the payment system and the intermediation process around that payment system and all the protection, then that's isolated and becomes less risky for the economy more generally. That's what we need to do again.
So Tom, let me then ask you, if you don't mind switching hats a little bit,
Sure.
about banks right here in Europe, because we've been speaking a great deal about Irish banks. They need more capital injected into them. Spanish banks, how concerned should we be about the threat to the global financial system?
Well, I don't know enough about the banks in Europe to be able to describe that, but I do know from the U.S. that your banks need to be, in the good times, well capitalized. And what happened in the U.S., and I suspect globally, was that because these largest institutions in the world, but certainly the largest institution in the United States, were judged to be too big to fail by the market, their leverage, that is the amount of debt they could take on versus the equity they had, went from numbers like 15, 16 to 1 to 30, 35, 40 to 1. And therefore the margin of error was narrowed so significantly that when the bad times hit, there was no cushion. And so we need prospectively to address that and make sure it doesn't happen again. More capital is, I think, important to have. Now, you'll hear arguments that will impede growth, but I suspect that I would prefer a little less solid growth that's dependable than a little bit of
the system is a
boom
little
and bust.
safer and they're putting more capital
Because
aside for a rainy day.
I don't want to see people unemployed because of financial crisis that spill over into the real economy.
So right now, we're seeing something of a divergence between the ECB and the Federal Reserve, you know, the two most important central banks in the world, arguably going in two completely different policy directions. Is this a good thing or a bad thing?
Well, I do think that the value of having independent banks that are part of other, their own economies, I think is important. And so I respect the ECB's decisions to go whichever way they're going. And then but my point of view is towards the Central Bank of the United States, which I have some responsibility with. And there, I think our policy, as I said, needs to be thinking about withdrawing. And I keep telling people, I'm not advocating for tight monetary policy.
So what the ECB is doing is a mistake?
I have no idea what the ECB is doing, whether it's a mistake or not. They have people who make that judgment and let them make that judgment. My concern, though, is for the U.S.
Tom Hoenig, President of the Federal Reserve Bank, Kansas City. Great to have you in the studio with us. Come in again.
Sure.